Okay, so good afternoon again, class. Let's now proceed to another problem wherein we will have to apply what we have discussed on the computation of consolidated income. In this problem, class, Laughter Company issued equity instruments in exchange for 75% interest in Tears Company. So here, Laughter is the parent, while Tears is the subsidiary. Tears Company's net identifiable assets have carrying amount and fair value of 300,000 and 360,000 respectively. The difference is attributable to a building with a remaining useful life of 6 years. The December 31, 2001 statements of profit or loss of Laughter Company and Tears Company are summarized as follows. Okay, so the revenues are 1,200,000 and 480. The operating expenses are 960,000 and 400,000. Here, class, unlike the previous illustration, there is no mention of any dividend income here, so there's nothing to remove. So we can actually rely already on the income reported by the parent and the subsidiary. However, there will now be an adjustment, class. And this is the first, we are now going to discuss the first possible adjustment to the income of the subsidiary, class. Okay, as an advance note, even the income of the parent will also have adjustments. But commonly, the adjustments are for the income of the subsidiary. Okay, so the most common source of adjustment, class, as I mentioned in the previous video, was the difference in the valuation in the eyes of the subsidiary and in the eyes of the consolidated entity. And that's exactly what we have here. The carrying amount of a depreciable asset, class, a building, in the books of the subsidiary, class, is 300,000, while the fair value is 360,000. So if you ask the subsidiary how much is the value of the building, the subsidiary would say it is 300,000. But if you ask the consolidated entity how much is the value of the building, it would say it is 360,000. Okay? No doubt, in preparing your consolidated income statement, we will follow the perspective or the viewpoint of the consolidated entity. But if we rely on the income statement of the subsidiary, class, you should understand that it is based on the carrying amount. Then you would ask the question, we're dealing with the carrying amount of an asset. How is that relevant to the income statement? An asset is reported in the balance sheet. How is these values relevant in the income statement? Again, as I have demonstrated in the previous video, class, the difference in the carrying amount, the difference in the valuation, class, would have an effect on the related depreciation expense. So in this case, if the subsidiary, class, if the subsidiary has a building with a book value of 300,000, the related depreciation in the eyes of the subsidiary, class, would be 300,000 divided by 6. So that would be 50,000. Again, if we ask the subsidiary how much is the related depreciation in this building, it would be 50,000. But if we ask the consolidated entity how much should be the depreciation expense of this building, it would be 360,000 divided by 6 years, or in the amount of 60,000 per year. In the eyes of the subsidiary, 50. In the eyes of the consolidated entity, 60. There's a difference of 10,000. Okay. Now, if we look deeper into the 400,000 operating expense of the 400,000 operating expense of the subsidiary, class, Tears Company, the 400,000 there, class, includes already the depreciation of the building in the amount of 50,000 for a while, class. So out of the 400,000 class, 50,000 pertains to the depreciation of the building. Now here comes the consolidated entity class. He is now looking at the subsidiary. How much is of the subsidiary? The records of the subsidiary shows 400,000. Then the consolidated entity would say, I do not agree, because out of your 400,000, you only needed 50,000 depreciation. The correct depreciation expense for the building for the consolidated entity is 60,000. But how much was included in the operating expenses as reported by the subsidiary? Only 50. So in the eyes of the consolidated entity class, the operating expenses of the subsidiary is understated by 10,000. It is lesser by 10,000. That the correct amount in the eyes of the consolidated entity is 410,000. And since the operating expenses as reported by the subsidiary is understated, in the eyes of the consolidated entity class, the profit reported by the subsidiary, by Tier's company, is also overstated by 10,000. Again, because the consolidated entity believes that the operating expenses is understated by 10,000, then it will follow that in the eyes of the consolidated entity, the profit of the subsidiary is overstated by 10,000. And that is the adjustment that we would need. So if you ask the consolidated entity how much then is the profit of the subsidiary, it should only be 70,000. Okay, and again, the reason there being the difference in the perceived correct amount of depreciation in relation to the building. Okay, in some problems class, the 10,000 adjustment here is what is referred to by some authors as an amortization of the excess. Okay, what excess are we talking about here? The excess of the fair value over the book value or the carrying amount. Okay, go back to the first paragraph of the problem. The carrying amount of the building, the asset is 300,000. The fair value is 360,000. There's an excess of 60,000. The fair value exceeds the carrying amount or the book value in the amount of 60,000. And the problem tells you that the excess or the difference is attributable to the building with the remaining useful life. So some books would discuss this class that the adjustment here is simply 60,000 divided by 6 years. Again, the 60,000 here is the excess, the difference between 300 and 360. Okay, and you will amortize that over the useful life of the thing. So 60,000 divided by 6 years, you will have amortization of 10,000. Okay. But again, how do we explain the 10,000 class? Okay, some students would have a hard time understanding amortization of excess. Why is there a need to amortize the excess? The excess here, class, principally comes from the difference in the depreciation expense reported by the subsidiary and the depreciation expense that should be reported as far as the consolidated entity is concerned. Okay? So some would say, to simplify, without talking about the source of the adjustment class, simply amortize the excess class. Okay? But again, the source of the amortization here class is really just the difference in the amount reported by the subsidiary and the amount that should be reported from the perspective of the consolidated entity. Now, very important note, class, please understand that the adjustment to the income of the subsidiary is not always a deduction to its income, class. The adjustment to the income of the parent, sorry, the adjustment to the income of the subsidiary is not always a deduction. But why is it a deduction in this case? Because the consolidated entity stated, hence income is overstated. And to correct an overstatement, you will deduct the overstatement. Now, when will it happen that the adjustment is not a deduction? Meaning, when will it happen that the adjustment is an addition? If it's the other way around, class, if it's the carrying amount that is greater than, if the carrying amount is greater than the fair value. Because in that case, the depreciation expense that is reported by the subsidiary would now be higher than the depreciation expense that will be reported by the consolidated entity. But that is very rare, class. That is very rare. Why? Especially for depreciable assets. That is very rare because if you already know, class, if you are the subsidiary, if you already know that the fair value is lower than the carrying amount, what does that tell you? It tells you that your asset is impaired. So you should already write down the value of your asset. And when you write it down to its fair value, then there will no longer be a disagreement between the value of the asset from the eyes of the subsidiary and the value of the asset in the eyes of the consolidated entity. But in the event that the subsidiary did not record any impairment loss, class, then it's possible that the depreciation expense of the subsidiary, as reported in its separate income statement, is greater than the amount that should be reported in the eyes of the consolidated entity. Okay, but again, the common scenario here is that the adjustment to the income of the subsidiary would be a deduction. But again, it's possible that the adjustment would also be an addition. Okay, now, having discussed that, class, let's solve for the consolidated profit. Again, how do we arrive at the consolidated profit, class? Income or profit of the parent from its own operations. And as I've told you before, the amount given in this problem is already the income of its own operations, as there had been no mention of any dividend income, plus the adjusted income of the subsidiary. Okay, so how much is the income of the parent from its own operations? In this problem, it is 200,000. Just add the adjusted income of the subsidiary. How much is the adjusted income of the subsidiary? Is it 80,000? No, it is 70,000. How did we get 70,000? By adjusting or deducting 10,000 from the 80,000 profit reported by the subsidiary. Where did we get the 10,000? The 10,000 is the difference between the depreciation expense included in the 400,000 operating expense of the subsidiary and the 60,000 that is the correct depreciation as far as the consolidated entity is concerned. Or how else can we arrive at the 10,000 adjustment, class? By amortizing the excess. How much was the excess? Book value of 300, fair value of 360, excess of 60,000 to be spent out or amortized over 6 years. So the answer in the first question in this problem, class, the answer in the first question in this problem is 310,000. That is 40 income of 70. So, what other question, class, will the answer be 310,000? Consolidated profit using the entity approach. Class, the primary difference, class, between consolidated income using the parent approach and the consolidated income using the entity approach on one hand, parent approach on the other, principal difference is the share of the non-controlling interest in the profit of the subsidiary. In consolidated profit under entity approach, we do not deduct yet the share of the NCI. Under the parent approach, to arrive at the share of the parent in the consolidated profit, we remove the share of the non-controlling interest. Okay? But again, it's just from the profit of the subsidiary. Of course, the non-controlling interest do not have any claim in the profit of the parent. Second question, how much is the consolidated profit attributable to the owners of the parent? Okay, stated differently, how much is the consolidated profit attributable to the parent? How much is the consolidated profit using the parent approach? Again, what's the difference? Just deduct the share of the NCI. Share in what? Share in the income. Whose income? Income of the subsidiary. Okay? So common error in the students class. They already computed the 310,000 correctly. And how do they get the income attributable to the parent? They will just multiply 310 with 75%. They will simply remove 25% of the 310,000. And why is that wrong? If you do that, class, it's as if you are letting the non-controlling interest share also in the profit of the parent. Remember, the 310 includes the profit of the parent. And the non-controlling interest in the subsidiary class should not have any participation in the profit of the parent alone. So what should be the correct treatment here? If you already have the 310,000, you compute for the share of the NCI, the share of the non-controlling interest in the income of the subsidiary. How much is the income of the subsidiary? 80,000 or 70,000? You will be using 70,000 plus. Once you have determined the adjusted income, it should always be the adjusted income that will be used. So how much is the adjusted income of the subsidiary? 70,000. How much is 25%? 25% here is the non-controlling interest class. How much is the 25% of the adjusted income of the subsidiary in the amount of 70,000? 70 times 25%, that will give you 17,500. So you deduct 17,500 from 310,000, you will arrive at 292,500. So the answer in the second question is 292,500. And we have actually solved the third question already, class. How much is the consolidated profit attributable to the remaining life of 5 years? Had a book value of 280,000 and a fair value of 300,000. All's remaining assets had book values equal to their fair values. Okay, so meaning, class, this is the last sentence I've read is relevant in determining whether there will be adjustments to the income of the subsidiary. Okay, here the remaining assets of the subsidiary had book values equal to their fair values. So as to all the other assets, class, no problem, no difference. And since there is no difference between the book value and the fair value, the valuation in the eyes of the subsidiary and the parent, the valuation in the eyes of the subsidiary and the consolidated entity would be the same. Okay? The only problem here is with regard to one asset class, particularly an equipment with a life of 5 years. The book value, meaning the value in the eyes of the subsidiary, is 280,000. While the fair value, meaning the value in the eyes of the consolidated 1,000. Okay? So, this will now be the source of our adjustment class. Okay? So, you could actually say that the fair value exceeds the book value in the amount of 200,000. Okay? And, sorry, not 200,000, but 20,000. And the difference, class, would be amortized over 5 years. Okay? So 20,000 divided by 5 years, you would get 4,000 per year. Now, for it to make sense, how do we Explain this 4,000. Where does this come from? The 4,000 class comes from the difference in the depreciation expense on this equipment as reported by the subsidiary and as should be reported as far as the consolidated entity is concerned. Okay? So if we ask the subsidiary, how much is the related depreciation expense on this equipment? The subsidiary would say the depreciation expense is 280,000 divided by 5, and that would give you 48,000. So the subsidiary will report depreciation expense in the amount of 48,000. Now, if we ask the consolidated entity, how much should be the depreciation expense on this? How much should be the depreciation expense in this equipment? The consolidated entity would compute it as 300,000 uh, divided by 5. 300,000 divided by 5 will give you 60,000. Let me just check my computation. 280 divided by 5. Sorry, 56. Sorry, because it's not 48 or 56. In the eyes of the subsidiary, the depreciation expense is 56,000. 280 divided by 5 will give you 56,000. While the depreciation expense, as far as the consolidated entity is concerned, is 60,000. How much was reported by the consolidated entity? 56. How much should be reported as far as the consolidated entity is concerned? 60. So there's a difference of 4,000. Okay, and that is now the adjustment to the income of the subsidiary. Okay. And again, understand Lisa, that adjustment will happen every year because the depreciation expense will be recorded by the subsidiary and the consolidated entity every year. Okay. Now, let's compute for the consolidated income. This problem asks for 2017. Let's start with 2016 class. Okay, take note that WOW is our parent while O is our subsidiary. So for 2016 class, CI here, CI here stands for comprehensive income. The comprehensive income class of the parent in 2016 is 185,000. Okay, while the comprehensive income of the subsidiary is 40,000. Now the question is, do we have to remove anything from the 185,000 income of the parent? You will always have to check that class, whether the amount given for the parent is already the income from its own operations. Okay? And the answer class is the 185,000 is already the income from its own operations. How do we know? Read the next set of figures. WOW's comprehensive income as shown does not include any dividend income from O. Okay? Since the problem expressly stated that it did not include any dividend income class, then there's nothing to remove from the 185,000. So, can we use the 185,000? The answer is yes. Okay, the answer is yes. So, we already need the first thing we need. We already have the first thing we need to solve for consolidated income class. What else do we need? We need the consolidated income of the comprehensive income of the subsidiary, but it must be the adjusted income. Let me just change the layout. Okay, now let's try to solve class. First, we need is the income of the parent from its own operations. Okay, the income of the parent from its own operations in 2016 is 185,000. Okay, then add what? The adjusted income of the subsidiary. Now, how much did the subsidiary report as income class? It reported income in the amount of 40,000. But what's wrong with the 40,000 class? What's wrong with the 40,000? The 40,000 is not yet adjusted. How do we know? The 40,000 is based on depreciation expense in the amount of 56,000, but the correct depreciation expense should be 60. So how does the consolidated entity view this 40,000 class? In the eyes of the consolidated entity, the 40,000 profit of the subsidiary is overstated. Why is it overstated? Because its depreciation expense was understated. How much depreciation expense did it report? Only 56. How much should it report as far as the consolidated entity is concerned? 60. So in the eyes of the consolidated entity class, the depreciation expense is understated, thereby resulting to an overstated income or profit. So in the eyes of the consolidated entity, the 40,000 profit is overstated by 40,000. So in the eyes of the consolidated entity class, the correct income or profit of the subsidiary is 36,000. Okay. So that means the consolidated income then is 221,000. So the only way you'll get this wrong class is if you simply added 185 and 40. Is that clear? Another way you can get this wrong class is if you deducted dividend income from 185. And hopefully nobody will do that because the problem is very clear that the amounts reported by the parent does not include any dividend income. Okay, so if the question is compute fully consolidated income, your answer would be 21. Using the entity approach, 221,000. Consolidated income using the parent approach, still to be solved. How do we solve for the consolidated income using the parent approach or the consolidated income attributable to the parent? Deduct the share of the NCI in the income of the subsidiary income. So first, get the share of the NCI. Share in what? Share in the income. Whose income? Income of the subsidiary. In the basis, it should be the 36,000. Okay. So, how much is the NCI in this problem? It says that the parent purchased 70%. Okay, so the NCI here is 30%. So to get the share of the NCI class, 30%, you would get 10,800. Once you have 10,800, you deduct it from the consolidated profit of 221,000, you would get 210,200. Okay, this would be your consolidated income attributable to parent. This is for 2016. For 2017, the income of the parent class is 210,000. Do we have to make any deduction from the 210,000? No, because this already does not include any dividend income from the subsidiary. Next, how much is the income of the subsidiary in 2017? It is 67 Okay, is that what we are going to add with the 210,000? No, because the 67,000 is not yet the 67,000 is not yet the adjusted income. What adjustments do we need? The difference in the depreciation expense or the amortization of the excess in the amount of 4,000. So this one minus 4,000. That will give you 63,000. Again, you will have to do this every year until the asset is fully depreciated. So in the sixth year class, no need for amortization, no need for adjustment because the asset is no longer there. There will no longer be a difference in depreciation expense. So that means if you are asked how much is the consolidated income or the consolidated income using the entity approach, that would be 273,000. That would be 273,000. Next, consolidated income attributable to parent or consolidated income using the parent approach. What do we do? From the 273,000, simply deduct the share of the NCI in the income of the subsidiary. How much is the non-controlling interest here? 30%. Okay, you get the 30%. 30% of what? The income of the subsidiary. Is it the 63,000 or the 67,000? The 63,000, always the adjusted income class. Always the adjusted income. Okay? So that means the consolidated income attributable to parent in 2017 is 191,100. There's actually a second question here, class. How much is the retained earnings after 2016 and 2017? There's a lot of things to remember here, so we will skip this one first. Let's try to master first. Uh, your ability to compute, your ability to compute consolidated profit. Okay, let me just. Okay, so we'll have this one. On January 1, 2001, ABC Company acquired 80% interest in XYZ Incorporated by issuing 5,000 shares with fair value of 15,000 per share. On this date, XYZ's equity comprised of 50,000 share capital and retained. And was measured at its proportionate share in XYZ's net identifiable assets. Okay. XYZ's assets and liabilities on January 1, 2001, the date of the acquisition, approximate their fair values except for the following. You have two assets class whose book value or carrying amount do not equal or approximate their fair values. So this would be the source of our adjustment class. This would be the source of the amortization. Okay? But the primary difference here with the other problems we've discussed class is that here we have inventory. Plus, there's a difference in the treatment of the excess or the difference in value between inventory and equipment. In equipment class, the source of the adjustment here is the difference between the depreciation expense reported by the subsidiary and to be reported by the consolidated entity. For inventory class, the source of the adjustment here would be the difference in the cost of goods sold. Okay? So what happens here? At the start of the year, we have inventory in the amount of 23,000 and 31,000. In the eyes of the subsidiary, the value of the inventory is 23,000, while the value of the inventory is 31,000 in the eyes of the consolidated entity. Uh, okay. By the end of the year, class, the same inventory will now be part of the cost of goods sold. Following first in, first out, there is a presumption that the inventory on January 1 that were present on January 1 would already be part of the cost of goods sold for the year. Now, how do you compute for cost of goods sold? Cost of goods sold is first beginning inventory plus purchases, net purchases would give you your total goods available for sale. And you deduct your ending inventory, you would be able to solve for your cost of goods sold. Okay? The 20,000 here, and if you check the income statement of the parent class, if you check the income statement of the parent, you have their dividend income of 4,800. So what does that tell us about the 64,800 profit class? What does it tell us about the 64,800 profit? The 64,800 profit class includes the dividend income from the subsidiary. And what are we supposed to do? Remove the dividend income from the subsidiary because what we need is the income of the parent from its own operations. So instead of 64,800 class, we will deduct 4,800, the amount of dividend income received from the subsidiary we will deduct 4,800 from 64,800. So that means the income of the parent from its own operations is equal to 60,000. Next, what do we need? What else do we need? We need the adjusted income of the subsidiary. Is it the 20,000? Is it the 20,000? The answer is no. Okay, because we still need adjustments to the uh, income of the subsidiary. How much income did the subsidiary report, class? 20,000. What are the possible adjustments? Two possible adjustments. The one coming from the difference in the carrying amount and the fair value of the equipment and inventory. Let's start with the equipment class since we are familiar already with the equipment. Okay, how much is the difference, class? 50,000, carrying amount, fair value 60,000, difference of 10,000. To be amortized over how many periods, class? To be amortized over 4 years. So 10,000 divided by 4,000, divided by 4 years, class, would give you 2,500. And since it is the fair value that is higher, this would be a deduction. Okay, but what else? The inventory. Okay, focus now on the cost of goods sold, class. Focus on the cost of goods sold. Okay, the cost of goods sold here, class, uh, is 72,000. As reported by the subsidiary class, it is 72,000. But what's wrong with the 72,000 class? What's wrong with the 72,000? The beginning inventory used there is 23,000, while the amount that should be included there, as far as the parent is concerned, as far as the parent is concerned, class, should be 31,000 for a while, class. Okay. So, uh, to analyze the cost of goods sold class, in the eyes of the consolidated entity, the fair value class, the beginning inventory, is understated by 8,000. Okay, it was reported by the subsidiary 23, but the the consolidated entity believes it should be reported at 31. So the consolidated entity believes that the beginning inventory is understated by 7,000. Okay, if the consolidated entity believes that the beginning inventory is understated by 8,000, it must also believe that the total goods available for sale is also understated by 8,000. And if it believes, class, if it believes that the total goods available for sale is understated by uh, 8,000, class, then the cost of goods sold must also be understated as far as the consolidated entity is concerned. By how much? Also by 8,000. Okay? Now, if the cost of goods sold is understated by 8,000, what is its effect on the income, class? What is its effect on the income? It is understated also, but it will now be overstated by 8,000. The consolidated entity believes that the cost of goods sold is understated by 8,000, so that means it believes that the income is overstated by 8,000. So we would have to add 8,000, deduct 8,000. Okay, I hope this makes sense to you. Okay. Okay, here it's 72,000, but the constituted entity believes that this should be 80,000 plus. Let me just type the comparative. Okay. So this here is what is reported by the subsidiary, but the consolidated entity does not agree. The consolidated entity class believes that the cost of goods sold should be 80,000. Okay. No problem with the income class. The constituted entity agrees that it's 120,000. It just does not agree that this should be 72,000. The cost of goods sold should be 72,000. Okay. Now what else? The 10,000 here represents depreciation expense. I think we miscalculated the amortization earlier class. Okay. The depreciation expense uh, reported by the subsidiary is 10,000. Okay, but does the consolidated agree? No, the consolidated entity believes that the depreciation expense should be 12,000. Okay, and we do not have any problem with the distribution cost in the amount of 18,000. So that means the income of the parent, the income of the subsidiary class in the eyes of the consolidated entity should be 10,000. Okay, by adjusting the cost of goods sold representing the uh, difference in the beginning inventory as perceived by the subsidiary and the consolidated entity and difference in the depreciation expense. Okay. But another way of solving the 10,000 class is by starting at the 20,000, class and deduct the difference of 2,000 class. We incorrectly computed earlier class because we failed to properly appreciate the problem when it says that the fair value is 50 and 60. The 50 and the 60 here class is based on their original life as can be inferred from the given accumulated depreciation. Okay, so if 50 divided by 5 and 60 divided by 5, this will give us 10,000 and 12,000. Okay, the 50 and the 60 here are not the carrying amount and fair values as of 2001. These are their correct carrying amount and fair value net of depreciation on the first year of the combination class is already 40 and 48. So it is the 40 and the 48 that will be divided by 4 years. So 40,000 in the eyes of the subsidiary divided by 4 years, the depreciation in the eyes of the subsidiary would be 10,000. 48,000 in the eyes of the consolidated entity divided by 4 years, the depreciation in the eyes of the consolidated entity would be 12,000. So here we would still arrive at 10,000. Okay. Now to solve the problem class, the income of the parent from its own operations is already 60,000. Then add the adjusted income of the subsidiary. How much is the adjusted income of the subsidiary? 10,000. Okay, you add the two. Consolidated income then is 70,000. Okay. Next, if you want to solve for the consolidated income attributable to the parent only, you have to deduct the share of the NCI in the income of the subsidiary. Okay, how much is the income of the subsidiary? 10,000. Adjusted income, again, always adjusted income. Then, how much is the non-controlling interest? In this problem, it is 20% since the parent owns 80%. So times 20%. You will have 2,000. Okay. So 70,000 minus 2,000 class would give you 68,000. So the income attributable to the parent, income using the parent approach is 68,000. Consolidated income, 70,000. Consolidated income using the entity approach, 70,000. Share of the NCI in the income of the subsidiary, 2,000. Okay? So basically, class, the flow of the computation of consolidated income is very simple, class. Okay? You just need the income of the parent from its own operations, the adjusted income of the subsidiary, and deduct the share of the NCI in the adjusted income of the subsidiary. The biggest challenge is on the adjustments of the income of the subsidiary. What is the source of the adjustments of the income of the subsidiary? They arise from the difference in the fair value and the book value of the assets and liabilities of the subsidiary. Why? Because the valuation that will be used by the consolidated entity is the fair value, while the records of the subsidiary, even after the combination, will continue to be based on their original book values or carrying amounts. Okay, so we'll discuss any questions you may have, class, on this topic on Wednesday. Okay, that would be all for tonight. Share of the NCI in the income of the subsidiary, 2,000. Okay. So basically, class, the flow of the computation of consolidated income is very simple.